Economic concepts provide the foundation for understanding how individuals, businesses, governments, and financial markets interact within an economy. Financial planners use economic analysis to evaluate factors that influence investment performance, interest rates, inflation, employment, and consumer behavior. Economics examines how scarce resources are allocated to satisfy unlimited wants and needs. Understanding economic relationships enables planners to anticipate changes in financial conditions and assess their impact on client objectives. Economic concepts help explain market cycles, asset valuations, purchasing power, and long-term wealth accumulation. Because financial planning decisions are influenced by broader economic conditions, planners must understand both microeconomic factors affecting individuals and macroeconomic forces affecting entire economies. Macroeconomics focuses on aggregate economic activity, including gross domestic product, GDP, inflation, unemployment, fiscal policy, and monetary policy. GDP measures the value of goods and services produced within an economy and serves as a key indicator of economic growth. Inflation reflects rising prices and declining purchasing power, while deflation represents falling prices. Unemployment measures labor market conditions and influences consumer spending and economic productivity. Fiscal policy involves government taxation and spending decisions, whereas monetary policy is implemented by central banks through interest rate adjustments and money supply management. These variables significantly affect investment returns, borrowing costs, business activity, and household financial planning decisions. Interest rates play a critical role in economic and financial planning analysis. They represent the cost of borrowing money and the return earned on savings and investments. Central banks often adjust short-term interest rates to influence economic growth and inflation. Rising interest rates generally increase borrowing costs, reduce consumer spending, and may lower bond prices. Falling interest rates tend to encourage borrowing, stimulate investment, and support economic expansion. Interest rates affect mortgages, consumer loans, business financing, retirement planning, and investment portfolio performance. Financial planners must understand the relationship between interest rates and economic conditions because these factors influence both short-term financial decisions and long-term wealth accumulation strategies. Market cycles are another important economic concept relevant to financial planning. Economies and financial markets typically move through periods of expansion, peak, contraction, and recovery. During economic expansions, employment, income, and business activity generally increase. At market peaks, growth may slow as inflationary pressures build. Contractions or recessions are characterized by declining economic activity, reduced spending, and increased uncertainty. Recovery phases mark the return of growth and improved economic conditions. Understanding market cycles helps planners manage client expectations, develop appropriate asset allocation strategies, and encourage disciplined long-term investment behavior. Recognizing that economic fluctuations are normal promotes more rational financial decision-making during periods of uncertainty. The time value of money, TVM, is one of the most important concepts in financial planning. It is based on the principle that a dollar available today is worth more than a dollar received in the future because current funds can be invested to earn returns. The ability to earn interest, dividends, or capital appreciation creates an opportunity cost associated with delaying receipt of money. Time value of money analysis allows planners to compare cash flows occurring at different points in time and evaluate financial decisions consistently. TVM concepts form the basis for retirement planning, education funding, investment analysis, insurance evaluations, loan calculations, and estate planning strategies. A key application of time value of money is future value analysis, which measures how money grows over time when invested at a specified rate of return. Future value calculations help clients estimate the accumulation of savings, retirement accounts, education funds, and investment portfolios. The growth process is driven by compound interest, which allows earnings to generate additional earnings over time. The longer money remains invested and the higher the rate of return, the greater the future value. Financial planners frequently use future value calculations to demonstrate the benefits of starting early, maintaining consistent contributions, and allowing compound growth to work over extended investment horizons. Present value analysis is another essential TVM concept and represents the current worth of future cash flows discounted at an appropriate rate of return. Present value calculations help determine how much must be invested today to achieve a future financial goal. These calculations are widely used in retirement planning, bond valuation, business analysis, insurance settlements, and capital investment decisions. Present value reflects the opportunity cost of capital and allows meaningful comparison of alternative financial choices. By converting future amounts into current values, planners can evaluate the economic attractiveness of different opportunities and develop recommendations that align with client objectives and available resources. Time value of money calculations also incorporate concepts such as annuities, perpetuities, payment streams, discount rates, and amortization schedules. An annuity consists of a series of equal payments occurring at regular intervals and is commonly used in retirement income planning and loan analysis. Amortization schedules illustrate how loan payments are allocated between principal and interest over time. Together, economic concepts and time value of money principles provide a quantitative framework for financial planning analysis. Understanding these concepts enables CFP professionals to evaluate financial alternatives, forecast outcomes, measure opportunity costs, and develop recommendations that support informed decision-making and long-term financial success.